What's going on, everyone? Welcome to the Credit Plug channel. So for today, we're going to do another live, and I've actually enjoyed doing some of these live streams lately. Haven't done them in a while, but I think I'm going to be doing a lot more. So in today's video, we're going to talk about America's favorite credit union. That's Navy Federal Credit Union. Right now, people have been raving about Navy Federal forever. And one of the reasons why is because, as a lot of you guys know, Navy Federal has been giving out high limits, people getting $80,000 limits or these instant $25,000 limits. But the reason why I wanted to do this video is because from a lot of rumbling I've been hearing is that Navy Federal is not giving out the bag like it once did. Now, for those who don't know, if you have, let's say, less than a 700 credit score, oftentimes it's hard to get high limit approvals. But as everyone knows, Navy Federal is well known for giving people, let's say with less than a 600, a 580. I've seen credit scores as low as like a 570 getting approved for, let's say, $10,000, $25,000 Navy Federal credit cards, right? And so the reason why I want to do this live is because, again, I've been hearing rumblings that Navy Federal is not giving out these limits like candy like they once were a couple years ago. And I'm going to be sharing some of the latest developments that I discovered about what's going on in Navy Federal. So to give you some context, about, I would say, probably like 6 or 7 months ago, some of you might be familiar, there was a CNN article or video rather that came out about Navy Federal allegedly discriminating when it came to mortgage loans, right? And I actually did a response video to that. There was a gentleman, I believe it was in Texas, where he was not approved through Navy Federal, even though he had income. He was the owner of a company and had a decent credit score, but Navy Federal somehow denied him. And so right now, I just wanted to go over this. So there is a lawsuit against Navy Federal, actually several lawsuits. So this article comes from Credit Union Times. Pressure mounts over Navy Federal's alleged mortgage loan disparities. Now, just to kind of give you a summary about what's going on. So pretty much there are 9 different Navy Federal members who submitted a complaint, or actually a 65-page class action civil lawsuit filed in the U.S. District Court of Alexandria, Virginia. And so, again, this was originally filed in December, 3 days after CNN report claimed that Navy Federal has the widest racial disparity in approval rates among the nation's 50 largest mortgage originators. Now, before I go any further, I just also want to let you know that Navy Federal is the largest financial institution, or Navy Federal has the most amount of Black borrowers out of any financial institution in the country. So just keep that in mind, right? So the lawsuit alleges that Navy Federal's own data showed that it denied African American home loan applications at a rate of 52%, Latino home loan applications at a rate of 44%, while white applicants were denied at 23%. The complaint also described how Navy Federal approved a higher percentage of applications from white borrowers making less than $62,000 a year than it did from Black borrowers making $140,000 per year. However, according to Navy Federal spokesperson, Black borrowers make up 1 in 4 of its 13 million members. So think about that. When you really look at that, that's about 25%. So the Black population is overrepresented when it comes to Navy Federal. And we could speculate a couple reasons why, right? Of course, we have people who might have ties to the military, government agencies and so forth. But a lot of people were able to get into Navy Federal through other means. Now, I'm not going to get into all that in this video. But when you think about it, just overall, without getting emotional about this, when we're looking at the median credit scores across different race ethnicities, we all know that African Americans are usually going to be at the lower end of the spectrum. So to me, at least, it's not surprising to see that, okay, if Navy Federal, if 25% or 1 in 4 borrowers out of the 13 million members are African American, and African Americans when we're looking at overall group have lower credit scores, it's not really surprising that you would see overrepresentation in the denials, right? Because of, historically having these lower credit scores, right? So just going back to this again, Navy Federal is, undergoing this pending litigation, right? And again, I'm not really going to comment on whether it's true or not. We'll let the facts play out and, see what happens. But I did want to share some other revelations that I came across as well. Again, this is just overall, right? Latest data shows continuing disparity in credit union mortgage lending. Hispanics, Blacks, and other minorities were twice as likely to be denied first mortgages than whites in 2023. All right. So without getting into this, again, Navy Federal is basically at the center of this. But basically what they found was that the nation's largest credit union originated 10,133 first mortgage purchase loans to borrowers who are Black, Hispanic, and other minority, while it denied the same type of loans to 4,676 applicants. This equals a denial rate of 31%. Denial rates are calculated by dividing the number of denials by the number of originations. So again, 31.6% denial rate. By comparison, Navy Federal had a 16.4 denial rate for non-Hispanic white applicants. All right. So it's clear to see, it shows out in the data, but I really wanted to dive a little bit deeper and kind of let you guys know what's going on at a deeper level when it comes to Navy Federal. So what I did was I searched for NCUA data, right? So for those who don't know, NCUA is the National Credit Union Administration. And so they're the governing body of credit unions, right? So banks have, they have OIC, FDIC. When it comes to credit unions, they're governed by NCUA, right? So they have a lot of data that you could actually look up how credit unions are actually performing. So they have what's called a call report. So with these call reports, you can actually pull up information about a lot of different credit unions, their financial performance and so forth. So basically, what I did was I pulled up some information on Navy Federal just to kind of see what's going on when it comes to Navy Federal. So this is actually what I wanted to share with you guys. So let me just pull this up real quick. Oh, actually, I think I have it already up. So what I did was I compared information from 2023 compared to 2024. And this is essentially what it looks like, right? The call report is basically a summary of what's going on in the institution. And they have different sections. They have financial statements. They have cash and investment information, loan information. But what I particularly wanted to hone in was on the loan defaults, right? So I'll actually show you a summary of this, but this essentially shows the schedule of different types of non-commercial loans and lines of credit. So you have unsecured credit cards, you have non-federally guaranteed student loans, other unsecured loans, lines of credit, new and used vehicles, loan receivables. And at the top up here, you have 30 to 59 days late, 60 to 89, 90 to 178 or 179, and then over 180 days, but less than 360. And then you also have greater than 360. And over here, it shows the total number of delinquent loans, 60 days plus, and the total number of loan. So the total amount and then the total number, right? So this is the aggregate amount by category. And then down at the bottom, you actually have the totals, right? So pretty much what I did was I compared to, Q1 of 2023 versus Q1 of 2024. So this is just an example. You can go on and anyone can download these reports. This is public information. So I wanted to share with you the results that I actually found, right? So again, I summarized all this data so we don't have to go back and forth between different PDFs. But again, this is comparing delinquent loans and leases March 31st, 2023 to March 31st, 2024. And this is just comparing it year over year, right? So we're looking at these two different snapshots, basically quarter one of each year, 2023 and 2024. And in this column right here, we have March 31st, 2023. And in this one right here is 2024. So just looking at these different categories, all right? So when we're looking at the total dollar amount of the delinquent loans, let's just look at unsecured credit cards, which is this first one right here. So you have $543 million March of 2023. And in March of 2024, 815 million. So that was an increase, as you can see right here in red, of $271 million. So let me just put that in perspective. The total dollar amount of delinquent credit card, total balances of delinquent credit cards increased by 50% from one year to the next when we're looking at quarter one of each year, 2023 versus 2024. So it's gotten worse. And as you can see, just from these percentage changes, right, almost in every single category, the dollar amount in terms of increases in delinquent loans 60 plus days has increased. So with credit cards, it increased by 50%. So when we're looking at 2023 versus 2024, the new amount of dollar amount of delinquent loans increased by 271 million. So that's a 50% increase. When we're looking at non-federally guaranteed student loans, it also increased, not by much, because again, they're probably not doing that many private student loans, right? That increased by 47%. Looking at all other unsecured loans and lines of credit, so this could be like term loans and things like that, that increased by 52 million from 166 million in 2023 to 218 million. Again, I'm not going to go through all these categories, but I did want to highlight some of the more interesting ones. Now, right here at number 9, secured by first lien on single 1 to 4 family residential properties, right? So the total dollar amount delinquent in 2023, as of March 31st, 2023, $292 million. In 2024, it was 572 million. So it increased by 280 million. So looking at the percentage change, that's a 96% increase in the dollar amount of delinquent loans, 60 days plus, for first lien single 1 to 4 family residential properties originated in Navy Federal, right? So that's a huge increase. And then just looking at the total delinquent loans and leases in March of 2023, it was at 1.2 billion. In March of 2024, it was at $1.95 billion. So that is an increase of $740 million. So that's a 61% increase. And then, of course, when we're looking at the total amount of loans, so these columns right here, F through H or I, is basically the number of loans. So this is the dollar amount, and these are the actual number of loans, right? And of course, these follow suit as well. When we're looking at the number of delinquent credit card accounts, it increased by about almost 24,000, and that was a 41% increase. And then looking again at, let's just look at new and used vehicle loans, right? So when we're looking at new vehicle loans, it went from 45 million roughly to 83 million. So that was a $37.5 million increase. So an increase of 83% year over year. And then when we're looking at used loans, so it seems like Navy Federal does more of these used car loans versus new car loans. But we saw not as big of an increase, but in terms of dollar amount, it was a much bigger increase just because they're originating more used vehicle loans versus new vehicle loans. But this is very interesting because, when you think about it, new cars are usually going to be priced a little bit higher. And so we're seeing actually like a bigger increase in the defaults for new vehicles versus used vehicles. A used vehicle, you're probably going to get at a lower price point. But this is very interesting just comparing these two. So if you're looking at new and used vehicles, we're seeing a higher increase in the dollar amount of those loans defaulting and in the number of those loans that are defaulting. So when we look at the percentage increase in new car loan defaults from 23 to 24, that's a 66% increase. And then again, I think when we're looking at the biggest jumps, the things that sort of stand out is definitely going to be the increase in the mortgage default. So if we're looking at number 9, so this is going to be first lien, single, 1 to 4 unit family residential properties, right? So owner occupied properties, or this could be multifamily properties and things like that. 280 million increase. So again, overall, when we're looking at Navy Federal, the percentage of defaults is increasing across every single category. Now, right here, down here, I put from 12 to 20. This is commercial loans and lines of credit. So just to go back to show you based on the report where all this information is coming to. So if you go here, you can just go to delinquent loans. And if you scroll down here, so this has commercial loans and lines of credit. I didn't want to focus on that for the purposes of this video, but I did include all of these in the total. So, it all maps out. But just looking at the non-commercial loans and lines of credit, so basically any consumer types of loans, we're seeing just huge increases in the defaults. And another caveat I did want to point out, okay, so the information that's presented here, again, is 60 plus days late. This does not include the amount of loans that are 30 days plus late, right? So if it's less than 60 days late, it's not included in these totals. So what I mean by that is, if you see, let me zoom in a little bit more to give you some context. So if I zoom in a little bit more here, so this column right here, 30 to 59 days late. So as you can see, 319 million in credit cards. But when we're looking at totals, that's $1.3 billion, right? This is not included in the summaries that I gathered, right? And when you look at this, it's kind of funny how they sort of manipulate the numbers, right? So I basically took, these two columns here for each year. And that's basically how I arrived at these numbers. So this is 2024, right? So this 1.956 billion. So going back to my spreadsheet, that's what we have right here, right? So for 2024, we have this 1.956 billion. So that's basically where I got it. But again, the point I was making with that is the fact that anything that's less than 60 days late is not included in these totals. And it's very interesting how they're reporting this, because when you're looking at this chart, you might assume that they're just adding up these totals all the way to the right side, but they're actually not. They're only adding, I guess these last 4 categories, right? They're not including the 30 to 59 days late. And one thing you also got to keep in mind when it comes to how institutions are actually reporting late information is that, let's say if you have a 30-day late on your credit report, it was actually 60 days late. So they're not going to report it immediately when the account becomes 30 days late. They're actually going to report it once it's 60 days late. So that just goes to show how, I guess, soft the reporting is, because it's actually painting a better picture than what the reality actually is. So just going back to this again, we're excluding from this analysis any debts that are 30 to 59 days late, which for 2024, this was 1.3 $3 billion that's not included. So it's not being tracked when we're talking about the totals. When we're talking about the totals, we're only talking about 60 plus days late. All right. And so again, both reports, are going to look identical. And actually, let me just pull up 2023 really quickly just to show you all these reports are going to be pretty much identical. So, all right. So right here we have 2023. So just going back. So yeah, this is, as you can see, March 2023. And then here we have, this is March 2024, pretty much identical information. But just to kind of give you some more context, in March of 2023, we could see it was actually 1.4 billion that was being excluded. So just comparing these totals, right, and just going from, one page to the next, just to kind of give you some context of what's actually going on. So again, this is December 23. I think I pulled the wrong report. Oh, okay, March 2023. All right, so let's go back to delinquent loans. Zoom in a little bit more. Okay, March 2023. So again, this is essentially where I grabbed the data from. So we're comparing 23 and 24, right? But going back to the spreadsheet, looking at these, let me zoom in a little bit more so you can actually kind of see the comparisons, right? Credit cards increase, credit card defaults increase. And again, just talking about the total dollar amount increase 50%. Student loans by 47%, personal loans, lines of credit, 31%, new vehicle loans, 83%. And I think when we look at what's actually going on, we do see a lot of delinquencies when it comes to, repossessions, especially on new cars, right? This is an epidemic right now, so I'm not surprised. And another thing I also wanted to just chime in on when it comes to Navy Federal, right? Now, there's a lot of information out on how you could finesse Navy Federal, right? How to get these high limit credit cards, how to backdoor Navy Federal. You even have people discussing sort of borderline fraudulent behavior, right? Where people are doing these auto loan conversions where they get an auto loan from Navy Federal, where they get the check, but then instead of actually using that check to purchase a car, they deposit the check and then it somehow converts from an auto loan to a personal loan, right? So that through and through is fraudulent. So I wanted to share this article because this is something I came across as well. So this actually is a recent article that came out July 11, 2024. And it says the second police arrest a second person in Navy Federal fraud case. Right. So this person was apparently working with a former Navy Federal employee with deposit and stolen checks. So again, I just wanted to read this real quick. So Georgia police reported a second person was arrested last week in connection to ongoing fraud of a former Navy Federal Credit member services representative who allegedly attempted to cash more than $800,000 in fraudulent checks on members' accounts. Right. So right here, they actually have a picture of the person, and this was in Georgia. So pretty much, there was a lot of fraud going on. This individual was cashing checks totaling more than $800,000. Right. So when we talk about some of the changes that's going on with Navy Federal, and again, I don't have like personal, testimonies on Navy Federal changing, but I have spoken to a lot of people. And let's say, for example, someone who has a really high credit score, they have good income. A couple years ago, you would expect, let's say based off of your data points and information, that if you apply for a Navy Federal Credit Union credit card, it was an instant 25K approval. I mean, you didn't even have to have that high of a credit score to get a Navy Federal credit card. But now what I'm hearing is that those limits, yes, they're still giving them out, but in some cases, people are actually getting denied with favorable data points. And I think what Navy Federal overall is doing is tightening up a bit. Now, don't get me wrong, Navy Federal is still the biggest credit union. They're still going to be issuing out loans. But I did want to make the point how things are changing just in terms of the defaults are increasing across all loan categories when it comes to Navy Federal. And again, just going back to the spreadsheet, we're looking at multiple double-digit increases, right? And we're not talking about just small increases. We're talking about 96%, 68%, 83%, right? These are huge increases year over year. So think about this. In 1 year, the total amount of defaults for 60 days plus only, we're only talking about 60 days plus. We're not including less than 60 days, right? $740 million increase. It's actually more if we're looking at overall delinquencies, but $740 million. Now, again, Navy Federal is a $100 billion financial institution, right? So the grand scheme of things, I think they're okay. But how long can this continue to happen until something changes where these losses aren't mounting up? Because eventually, there's going to have to be some type of major change to address this, because when we're looking at this, I mean, this is substantial. The total loan volume in terms of 60 plus day defaults increased by 61% from 1 year to the next. When we're talking about a year over year, looking at the first quarter of 23 and 24, that to me sounds insane. And then looking at the total number of loans. So in 2023, there was 108,000 total delinquent loans, 60 plus days late across all categories. In 2023, 2024, as of March 31st, 147,000. So that's an increase of 38,877 new delinquent loans. That's a 36% increase. And when we're looking at the number of accounts, just looking at the change in the number of accounts. Okay, so we're looking at column H right here. Most of the delinquent accounts came with the credit cards. So of the 38,877 delinquent accounts increase from 1 year to the next, 23,808 of those were credit cards, right? So when we're looking at this top row up here, this is going to be credit card accounts, right? Unsecured credit card accounts. And then the second highest category is going to be, obviously term loans when we're looking at the total amount. And then used car loans and things like that. But another very interesting thing too, the mortgage loan defaults and the dollar amount increased by 96%, right? So in 2023, it was 292 million. 2024, 572 million. Now, when you think about, okay, obviously we're talking about higher dollar amounts, right? We're not talking about a $25,000 credit card. We might be talking about a $400,000, $500,000 mortgage, right? So in terms of dollar amount, I don't think it's too bad. I mean, 280 million is a lot, but you have to also think like when we're looking at the total number, right? So in 2023, it was 1,200 basically delinquent mortgages, first position mortgages, right? In 2024, it was 2,100. So this was an increase of about 904 mortgages that became delinquent year over year increase, right? And so this actually represented a 75% increase in the number of delinquent loans, right? So that's still substantial. You think about that, 904 more homes became delinquent in homes among Navy Federal originations year over year. So again, these numbers are not good. So I'm not sure how these are going to continue to play out, but I did just want to, reveal some of these stats. And again, anyone can go online and research this information. So let me just share this with you if anyone is actually interested. So this is called a call report. But if you go on NCUA .gov, they have a bunch of different reports. So you can look at, they have quarterly data. They have these different summary reports. They have financial trends. I just really looked at the call reports. They also have aggregate financial information. And then you can also download, this is where I actually was able to pull some of this information from. So basically right here, you can decide which cycle or, which date range you want to actually search for. They have this information. They have raw information as well. And then if you want the PDF reports, let me see, where was this at? I believe you can just search for these. Hold on one second. Recent. But yeah, anyways, there's a ton of information that you can get from here. So if you're interested in just doing your own research, I definitely recommend it. They have a lot of great information on here. And again, this is all public information. This is not something that I'm just pulling out of a hat. You can literally go online, ncua.gov, and download these data summary reports and so forth. So, and again, they have it at a national level as well. So a ton of great information. Now, overall, like I said, again, Navy Federal is not going anywhere, but these trends are definitely alarming, how we're seeing this increase in defaults. And again, this is not just at Navy Federal, but Navy Federal being one of the largest, or not one of the largest, the largest credit union in the United States. And we're seeing even online, like a lot of the information that you see, how to finesse Navy Federal. Everyone's trying to get into Navy Federal backdoor member hack, right? Like how to get in through the back door. So I don't know how you guys feel about this, but definitely let me know in the comment section, what's your sort of perception on what's going on with Navy Federal. In your opinion, has Navy Federal become more difficult to be able to get access to, financial products? Me personally, again, I've had credit cards with Navy Federal. I honestly don't use them that much, and I haven't applied for anything. But just from some of the anecdotal, evidence and conversations and observations that I had, is that in 2024, it's not as easy as it once was. So you guys let me know if anyone with, subs par or sub 600 credit scores, are you still able to get approved with Navy Federal? Now, again, at the end of the day, Navy Federal was over $100 billion organization. So if we're seeing, like, let's say defaults in the, I think it was about 1.9 billion, 60 plus days late. And if you add in like the 30 or less than 60, it probably goes over 2 billion or so. So 2 billion out of, hundreds of billions. In the grand scheme of things, that's probably not going to hurt them as much. But if the trend continues, how is Navy Federal actually going to react to, these mountain losses, right? When it comes to, credit cards, especially, and we're seeing it with mortgage loans. And if I were to actually have a hypothesis, I would say that if we look a year out, I think it's only going to increase, right? Because again, March 31st, we're in July right now. So we're about, let's say, 3 months or so out from the latest report. And so I think they'll probably have another Q2 report. They're probably working on it right now. And so it's probably not available just yet. But I am curious to see, how things have changed, if we've reached that peak. And I haven't looked at it. I'll probably do another dive into it to see, okay, how did these defaults compare to, let's say, the Great Recession, right, in 2008? As a matter of fact, we could do this right now. Let's do this right now. Let's have a little fun. So let's go. All right. So let's look at this. Oh, wait. I think research. I think this is it. All right. So what you basically got to do, and here I'll show you how to get these reports. when you research a credit union, you can just go up here. Let's enter Navy Federal and then go to find. All right. So then it'll pull it up right here. Then you just go to view. And then right over here, you have the call report and you could pick the cycle. So let me see how far back these go. So when was the Great Recession? Let's just say, I want to say it's like, let's just look at December 28. Actually, let's look at this. Let's look at March of 2019 or 2009. So here, I'm going to download that. And then let's open this up and see. Okay. This looks a whole lot different. All right. Yeah, these reports definitely have changed. So I just want to see. Okay, delinquent loans. Okay, so this will be hard to compare because the reporting was a little bit different. But let's blow this up real quick. So they've obviously changed the reports. Well, actually, no, it's not that much different. So I think they're using months instead of days, like in the other reports. So let's see. Let's see what this looks like. So, okay, total reportable delinquency. All right. So when we're looking at unsecured card loans, this was what, 60 million? And what were we looking at in, let's just compare. So 60 million back then. Wow, this is not even the same comparison. So there's so much more credit card debt now than even back then. Looking at this this report, actually, look at this. So even though that was the Great Recession back then, the amount of debt now is at a higher level. So they had 60 million in credit card debt. I know back then it was really the mortgages. So right here we have first mortgage real estate. So they break this out. So fixed rate and then adjustable rate. And so as you can see, the fixed rate obviously probably has a higher volume. But yeah, when you're looking at these numbers, even though it was the Great Recession at that time, it still doesn't compare to the delinquencies now. And then I would even take a guess. I would actually hypothesize that the numbers we're seeing right now in terms of the total amount of delinquent loan in terms of volume, it's probably at the highest it's ever been. I would just take a guess. And the reason why, and again, let's go back to this report as well. I've been referencing this a lot. So another thing you can do, you can check out the New York Federal Reserve. So they have a lot of great information. So let's just look at, all right. So let's see, where's this report? National Economic. Okay, quarterly report on household debt. All right, so they have this report. So let's just look at this real quick. And this is a really interesting report, right? And the point I want to make with this is just to give you guys context in terms of like how much debt has been generated over the past couple of years, right? So this actually goes back to, I guess, the Great Recession, right? So Q1, it just look like it's about a little after Q1 of 2008, right? So you had about, let's see, how much was this? This was about 500 million credit card accounts, right? So then we went through this cycle where it decreased, obviously, because a lot of credit card accounts probably defaulted and closed. So there was just this buildup in credit cards. And then we see during 2020, it got back to pre-Great Recession levels, right? So if we just drew a line to go straight across, that would pretty much show when the credit card accounts, the total number of personal credit card accounts got back up above like 500 million, right? So that happened around, it looks like about, let's say sometime in 2020, between 2020 and 2021. And then it just accelerated. So right now, as of Q1 of 2024, we're at the highest level ever, 600 million credit cards. So the number of credit card accounts went from 500 million, let's say in the time frame 2020 to 2021, and by 2024 we're at 600 million. So that's 100 million increase. Keep in mind, interest rates are high. Now, going back, someone in the comment section let me know, but from my understanding at Navy Federal, I believe their credit card rates are like 18%. At least that's what my credit card APRs are at Navy Federal, 18%. So we have a lot of credit that's out there. We also have high credit card interest rates, right? Because interest rates are relatively high. And we have inflation where people are carrying higher percentage of balances. So I don't even think we're at the peak of the total loan volume in terms of credit card defaults. But again, when we're just looking at the growth in the different types of financial accounts, credit cards have seen the biggest increase. And I know looking at this chart, it probably doesn't give you context, but when you think about 100 million new credit cards in 4 years, so let's say 25 million new credit cards per year on average, right? And then let's say that's like 2 million plus new credit cards every single month for the past 4 years on average. And then when we're looking at this 100 million credit card increase, you also got to look at, you multiply that 100 million by whatever the average credit limit is. And then, multiply that by the current default rates, right? So I think, let's go back. So just looking at this chart, I've shared this chart before. So you see this widening gap between housing debt and non-housing debt, right? So the non-housing debt is going to be the credit cards and everything, auto vehicle loans and so forth. So again, this is not a good sign. And just looking at this, when we're looking at just overall household debt, right? So, and again, this is coming from the Federal Reserve, right? This is not Credit Plug making up facts. Household debt rose by 184 billion in the first quarter of 2024. Delinquency transition rates increased across all debt types. All right. And again, looking at the growth based off of the different types of debt, right? So, of course, mortgage debt, because of the dollar amount, is going to increase, right? But let's just consider non-housing debt. Non-housing debt, credit cards by far has the biggest annual change, $129 billion. So total as of Q1 2024, $1.1 trillion in credit card debt, right? And again, they're using sort of the same comparison I did with the Navy Federal analysis, looking at Q1 23 to Q1 of 2024. And then right here, this shows the flow into delinquencies, right? Serious delinquency. So this is actually looking at 90 days plus. Let me see if I could change my screen. Okay, just so you guys can see this a little bit better. Sorry. Oops, Zoom is crazy. All right, so again, credit card debt obviously has the highest growth, right? From Q1 of 23 to 24. So in 23, it was 4.57%. In Q1 of 24, it's 6.86%. So when we're looking at the change, the delta between all of these different categories of consumer debt, credit cards had the highest increase in delinquencies, right? Accounts that are flowing into delinquency 90 days or more delinquent, right? So again, overall, what we're seeing is that delinquencies, especially on credit cards, are increasing substantially. And this is not just at Navy Federal, but Navy Federal, I think, is an example of, again, one of the bigger institutions. So we're going to see some of these numbers play out, especially at Navy Federal. But again, it's happening across the board. So I just wanted to say, how do you kind of navigate, I always say, look, get your credit in order, right? So if you do have derogatory items, if let's say, somehow, you weren't able to pay back your Navy Federal credit cards, one thing I would do is get your credit addressed, right? It's never too late to get your credit fixed. So if you're looking for a good resource, I recommend the Credit Pros, right? So if anyone is interested, I've dropped a link in the description of the video. So for those who don't know about Credit Pros, the Credit Pros is one of the best companies out there right now in terms of fixing people's credit. So if that's something you're interested in, I've dropped a link in the description of the video. Again, this is the #1 ranked and trusted credit repair service. Right now, I actually have a special offer. If you click the link, I'm going to pin it into the live stream. You can start with a $0 free trial. Use it. You can onboard. They'll give you all 3 of your credit reports. You could select items to dispute and see how it works for you. And again, there's no obligation, free trial. You guys can definitely check it out. Credit Pros, they're getting a lot of results, especially for a lot of our subscribers. So I highly recommend this. But anyways, I just wanted to share, some data points on what's going on with Navy Federal. You guys let me know in the comment section. Do you feel like Navy Federal has switched up? What's your experience with Navy Federal right now? I know you go online and, people are still getting approved, no doubt. But from just some of the conversations I've had, it seems like Navy Federal is not as freely giving it out as it once was. And this could be a result of what's going on more or less at a macro level. We're just seeing higher levels of default. And so just let me know overall what you guys think about this whole situation with Navy Federal. Is Navy Federal still your favorite financial institution? And I always tell people, and one of the reasons why I start making content about other credit unions, just to let you guys know that, there's over 5,000 credit unions throughout the United States. Navy Federal is the biggest, but they're not the only one where you can get financial products and banking services from. So you could definitely consider some. There's other alternatives to Navy Federal. In my opinion, personally, I think Navy Federal is overrated. I'm just going to keep it real. Navy Federal does not have unsecured business lines of credit, from my understanding, right? Their business credit card is very basic. Their credit cards are actually not that competitive, to be honest with you. I have a Cash Rewards, the Platinum, and the Amex one. And to be honest with you, I don't even use those. I think there's a lot more competitive cards. But I think if you are sort of starting out, they are a good institution to just get your foot in the door, because they are going to be traditionally a little bit more lenient than, let's say, if you went to an Amex or a Chase or Bank of America or one of the top banks. They're known for more or less working with people with less than perfect credit. But I think because of that, that could be a reason why currently they're in the situation that they're in. If you look at some of the other credit card default rates at other issuers like American Express, they've actually seen some of the lowest defaults because they already have higher underwriting standards. And in fact, let me see if I can pull up real quick. I'm going to see if I could pull up just a chart that shows you the default rates by credit card issuer. All right, let me pull this up real quick. Hold on. Let me pull this up. All right. So just going back. All right. So this, I think I've shown this a couple times before. So this is just, and again, this is from Fred, this is the Federal Reserve research. So basically this shows just kind of historically the delinquency rate on credit card loans at all commercial banks, right? So again, as you can see back in 2005, 6, 7, and again, I guess it peaked in, I guess it looks like Q3 of 2009, and then it has dropped all the way down for the past, decade or so until we got to 2020, Q1 of 2020. It went even lower. And then right now we're seeing as of Q3 of 2021, it's starting to climb back up, right? So if we draw a line from Q1 of 2024, where it's at 3.16%. So delinquency rate on all credit card loans at all commercial banks, 3.16%. So the last time we were at 3.16% or close to that, let's say about sometime between Q4 2011 and Q1 of 2012. So let's just say 12 years ago is the last time we were at that rate of defaults at all commercial banks. And at that time, remember, it's coming down. Right now, we're going up, right? It was coming down, now it's going up. So again, my hypothesis is that we're probably going to continue to see more defaults. I think we probably have at least another year out until maybe something changes. But currently, the way inflation is going, the way the credit markets are, the interest rates right now, I don't see this letting up, at least, within the next year or so if something changes. But you guys let me know what you think in the comment section. That's all for today's live stream. Let me know your comments and questions. Also, make sure you like, comment, subscribe, share. And if you are looking to get your credit fix, Credit Pros has a $0 free trial. This is a limited time offer. I pinned the link in the description of the video so you can get your credit on track. Also, if you're looking for inquiry removal, you're trying to apply for credit, but you have too many inquiries, you could also check out the inquiry removers. They help you with removing inquiries. Great company, get excellent results. Anyways, that's all for today's live stream. Until next time, take it easy and we'll talk to you soon. Peace.